Right now, markets are imploding. Japan's Nikkei just had its worst day since 1987, falling as much as 12.4%, before recovering to a mild 7% loss. But folks, the Nikkei is basically Japan's entire market. This was after 2 days of 5% declines. Here at home, the Nasdaq Composite fell over 5%, and the S&P 500 tumbled 3%. So what's happening? Well, it's something called the Japan carry trade, and it's exploding. Let's dive in. Okay, so what's the Japan carry trade? In short, it works like this. Japan's interest rates traditionally have been very low. Well, the yen was also weak. So what investors would do is they would borrow funds in Japanese yen, convert it to US dollars, and then buy assets with those cheap dollars, primarily stocks, bonds, and crypto. With a history of rock bottom interest rates and extremely limited volatility, shorting the yen to buy risk assets was viewed as a safe bet. This trade has historically worked so well that trillions of yens are estimated to have been borrowed and converted to buy these assets. However, every trade has risks, and after 15 years of near and sub-zero rates, the Bank of Japan earlier this year was forced to raise rates due to inflation pressures at home, ending an 8-year period of negative interest rates. In March, rates were raised by just 10 basis points in an effort to calm inflation. But that wasn't enough, which forced the Bank of Japan to take drastic action. They raised rates to 25 basis points, the largest increase since 2007. So today rates sit at 0.25% in Japan, still low by North American standards, but now investors need to actually earn a return on their investment for the carry trade to make sense. At the same time, the Bank of Japan indicated that they're open to further interest rate hikes, while stating that they plan to reduce their Japanese government bond holdings. The country will reduce monthly purchases of bonds from 6 trillion yen per month to just 3 trillion yen per month, which will be done gradually over 2 years. Basically, every month from here on out, we'll see monthly purchases cut by 400 billion yen until the new target is achieved. In other words, quantitative tightening, which is good for combating inflation, but not so good if you're currently short the yen. So let's look at the impact of raising rates and introducing quantitative tightening while other economies around the world are returning to rate cuts and quantitative easing. The simple answer, if you're Japan, your currency gets a lift, which is somewhat what the BOJ wanted. In April and May, they intervened in the currency markets and defended the 160 level with the dollar, spending 9.8 trillion yen in the process to do so. And earlier in July, they spent a further 5.5 trillion yen to again defend that level prior to raising rates. But here's the thing. What happens when a stock that is heavily shorted gets some positive momentum? You get a squeeze. GameStop should have taught the average investor that by now. Currencies are no different. It's just a bit more complex. Right now, amid market turmoil, we're basically caught in a short squeeze on the yen. With the price of the yen relative to the US dollar rising, investors are seeing their returns on their investments implode. Let's put this into context, borrowing the figures from a recent tweet by ex-user Row Rider, who uses crypto for the example. Last Monday, you borrowed yen at 0% interest. You then swapped it for $10 million in US dollars. Then you bought $10 million worth of Bitcoin. With rising rates in Japan and a stronger yen, that 10 million US dollars is worth 7% less in yen, and your debt is in yen. So that means you're down 7% as is. So now you have a gap of $700,000 that you need to make up. So you sell your Bitcoin to get back US dollars, which will then be converted to yen to settle your debt. But here's the thing. You aren't the only one caught short here. There's trillions of dollars out there that are still trying to stop their losses by selling their assets. So the price of Bitcoin is down and your position tanked by $2 million. Now your losses are at $2.7 million on a $10 million trade. And to settle your debt, what do you need to do? You got to sell other assets to make up the difference to settle the score, just like everyone else has to do, and that drives down the price of pretty much any liquid asset. It's one big negative feedback loop, which is why markets like stocks, bonds, and crypto alike are all currently crashing. So where does it all end? Well, Elizabeth Warren on Friday was already calling for emergency rate cuts from the Fed in an effort to spur investment. And that was before things imploded further today. And as one final oofta, here's a chart of the Mag 7 as compared to the chart of the US dollar versus the Japanese yen. So you probably get the idea of where we're headed. For the rest of us, all we can do is sit back and watch the implosion as it happens and hope we don't get hammered too hard.